When we do that, let's look at that same process for a 16 unit in LA, starting in 2016. Nothing too great, probably white collar tenancy, medium income property, just a very stable property to invest in. So we've got our $1 million property, and that we've bought with 20% down. We've paid $200,000 out of our pocket to invest in the property to acquire it. So after 1997, where we had 3% appreciation, it's now worth $1,030,000. The end of 98, where we had 8%, it's now worth $1,112,400. At the end of 1999, where we had 3% appreciation again, a property is now worth $1,145,772. So after 2000, where we had 6% appreciation, it's now worth $1,214,518. 8% in 2000, 9% in 2001 gives us a property worth $1,323,824. In 2002, with 13%, it grows to $1,495,922. 2003, where we get the appreciation kicking in now, it's 16%. Property is now worth $1,735,269. So in 2004, where we have 24%, the property grows to $2,151,734. And in 2005, where there's 20%, the property goes up in value to $2,582,081. And in the final year of 2006, where we have 7%, the property appreciates to $2,762,827. So when we look at our return on investment for the 16-unit building that we bought for $1 million in 1997, we see that our 1997 value, based on what we bought at $1 million. So after 10 years of appreciation, it's grown to its new value in 2007 is $2,762,827. So the $200,000 that we invested in 1997 has grown into $1,962,827 in 2007. And again, when we look at our return on investment, that's 881% growth over 10 years. Annually, year by year, that's 88% increase in value. And this is what Warren Buffett would call business rates of return. We're not talking about 2% or 5% or 6% from a term deposit in a bank. We're talking about business rates of return from multifamily units. So the thing I want to stress here is that was a pretty amazing series of growth over that 10-year period. 881% return on investment over 10 years. But that was just appreciation. If you remember at the beginning, we mentioned there were other reasons to invest in apartments as well. And those also add to our return. We have the net positive cash flow that comes in every month. This is what would be our cash on cash return. Also, there's the depreciation that we can claim every year as the owner of the property. The paper loss that the IRS allows us, the depreciation paper loss, we use that to shelter ordinary income from either our job or other income that we generate. And because we don't have to pay that money to the IRS and we can keep that in our pocket, that has to be calculated as part of our return. In addition, all of the equity build-up from the principal pay down the loan amortizing over the 10-year period also factors into our return, because when we sell the property and we transfer when we sell the property, the equity build-up is now equity that transfers into actual value that we transfer from one property to the next when we do our exchange. So when you add all these up together, that would add another 10% annually to our return on investment. So we're not really getting 881% ROI. It's more like 981, or probably closer to 1,000% ROI over that 10-year time frame. So I hope I've been able to show you here that apartments, for a whole range of reasons, are a great way to create wealth with very low risk. And the thing that to bear in mind about this is not an isolated incident. That it's not only Los Angeles that offers returns like this. The United States is not a homogeneous market, despite what you may see in the news where they try to generalize about all markets at the one. It's not the case. There are always markets in different US that are starting to recover at the same time that other markets in different parts of the country are actually topping out. And it might surprise you to know that even right now, at the time that we're making this video, when the subprime crisis is just really starting to get going, and everyone's screaming that you hear on investing mavens and finance sections of news shows, to listen to them, the sky is falling. But even right now, when you look into apartment investing and you do a little research and a little bit of analysis, you learn that even at this point where everyone is saying everything is so bad, there are markets that are about to explode. And that's what makes apartments just such an amazing opportunity, is because there are always markets that are about to explode as other markets are topping out. So you can go from one market to another market to another market. At the top of the market, transfer all of your wealth that's built up over the upswing in the cycle down to another property that's in the bottom part of a market about to trend upwards, and just keep your investment growing at a high rate of return, all the time being secured by apartment buildings, secure with real estate. So apartments are always a great opportunity to build wealth. So if this has been interesting to you and you'd like to learn more about how to build wealth with apartment buildings, you can find out more by going to www.apartmenthouseprofitmachine.com. That's www.apartmenthouseprofitmachine.com. And when you get there, sign up and you can receive your own copy of the Smart Guide to Apartment Investing. I hope this has been interesting for you, and I hope you got a lot out of it. We'll see you next time.